We all know that real estate is no longer cheap in Canada, where we've seen the price of properties exploding since the pandemic. But what if there was another way for you to invest in this market without having to put hundreds of thousands of dollars up front and without having to deal with the problems that comes with tenants? The solution to this problem would be to invest in real estate investment trusts, aka REITs. It is why in this video, I'll share with you 3 of the best Canadian REITs to invest in right now and to hold forever. First up on my list is an absolute essential when we're talking about the best Canadian REITs, which is also the biggest one amongst all of them. And it is the Canadian Apartment Properties REIT with the ticker CAR.UN. By being the largest Canadian publicly traded REIT, it owns over 46,000 residential apartment suites and townhomes, which exclude about 1,800 suites and sites classified as assets held for sale that are well located across Canada and the Netherlands. It makes that this company has an impressive total fair value exceeding $15 billion right now. But why do I believe that this REIT might be there to stay for the next couple of decades is the fact that they are operating in an essential segments of the real estate market. In fact, the needs to have a roof over your head is an essential need that will be there to stay for the future. Add to this, over here in Canada, we are currently in the midst of a massive housing supply problems where we are lacking a lot of houses compared to the new people that are coming in the country every single year. So it means that we would need to build millions of new homes before 2030 to be able to afford a certain affordability point, which is pretty much impossible at this point. And with the multiple threats of tariffs imposed by Donald Trump over the past couple of months, this has created significant uncertainty and recessionary concerns, keeping home buyers on the sideline, and at the same time, while unemployment is rising, which force renters to stay in the rental market. The only beneficiaries of this will be big businesses such as REIT that already have thousands of different properties all across the country. Plus, with the multiple rate cuts that have been made by the BOC over the past couple of months and with the future ones that are forecast for the rest of 2025, this should greatly help a company like REIT that currently have an average interest rate of 3.2% on all of their mortgage in Canada. When we look at the numbers, we can also notice that the 2 most important provinces in which REITs are present is in Ontario and in Quebec, where both of these provinces represent over 66% of their total units. And at the moment, their Netherlands market isn't that much exploded, where they only have about 2,600 units, which represents about 5% of their total units. Unfortunately, by proceeding to the sales of 1,500 units in the past quarter, we've seen their total revenue drop by about 6% year over year, which has also had the impact to diminish their total funds from the operations. Nevertheless, as I mentioned earlier, the interest to invest in these types of businesses is because of the high monthly income that they are providing, since they must distribute about 90% of their total taxable income to their shareholders. In their case, they are currently distributing a dividend of over 3.5% with, however, an excellent FFO payout ratio of only about 65% right now. In terms of the net asset value of this company, aka the NAV, which is basically the total assets of the business less the total liabilities that it has, we can notice that their NAV has been diminishing by about 2.5% year over year. Nevertheless, it remains that by purchasing this company that has a price to NAV ratio of about 0.80 right now, you would be buying a business at discount compared to what is its current net asset value. Now, for the second REIT on my list, I've decided to go into another sector of the real estate market in Canada, which is the industrial market, and I've picked a company that is at the backbone of the modern logistics in Canada, which is the business Dream Industrial REIT with the ticker DIR.UN. With online shopping that has gained tremendous popularity since the pandemic, there is one thing that remains sure. People will continue to buy different goods either in physical stores or in e-commerce stores. This means that these goods will need to be transported and stored at certain places and locations, and it is where Dream is pretty essential for us. By having over 71 million square foot of leasable area, this REIT has numerous industrial projects such as distribution distribution facilities, urban logistics, and industrial outside storage. It is also interesting to note that Dream as the company also has other different subsidiaries in important real estate markets such as the residential, the office, and the retail fields. But what interests us today is their industrial branch that currently has over $7 billion worth of properties spread across Canada and different European countries. For example, countries such as Spain, France, the Netherlands, and Germany. Globally, their real estate portfolio is highly focused into high-density populated urban territories since they'll tend to be the locations where people will purchase the most goods and where they'll need to store them as well. It is also important to note that since 2018, we've been able to see that this REIT has been able to massively outperform the Canadian index that is tracking the all real estate market companies. So it is fair to say that for its total return, which obviously include all the capital gain and the total dividends that you would be earning from this company, this business would be an elite real estate company in Canada. Additionally, in their latest earnings report, we've seen a great 6% increase year over year in their net rental income, which has also helped them to slightly increase their total funds from the operations compared to what they used to be 1 year prior. And another good news for the investors in this company is the fact that it is currently distributing a dividend that exceeds 6% that is also paid on a monthly basis, and that also has an excellent FFO payout ratio of only 69% right now. In terms of their net asset value, we can see that in their latest earnings report, this number was at 16.76% per share, which represents a slight increase of only 4 cents compared to what it used to be 1 year ago. However, with a price to NAV ratio of 0.67 right now, we can understand that this REIT would currently be more undervalued in terms of the discount that it offers to their shareholders compared to another REIT such as CAPREIT. Finally, the third and last REIT that is on my list is one that is tracking the whole retail market in Canada, and it is a business SmartCentres with the ticker SRU.UN. With over 195 properties and over 35.4 million square foot of rental areas spread across Canada, SmartCentres primarily invests into big retail properties, notably big supercenters that already have tenants that are paying them every single month. Some of the most popular tenants and clients of SmartCentres are notably companies such as Walmart, Costco, Sobeys, Canadian Tire, Dollarama, and way more. With the pandemic and with the close of multiple stores and supercenters, many people thought that the classical stores were there to be replaced by the e-commerce stores. However, we are forced to say that it might not necessarily be the case when we see that a company like SmartCentres currently have an occupancy rate exceeding 98% right now. It means that this Canadian REIT remains and keep having great quality tenants that are able to pay them every single month. But it is also interesting to note that this Canadian REIT has also started to adapt its business model to buy and build new constructions of other types, notably offices, apartments, self-storage, and parking lots, which are all helping them to generate some income every single month. Since the IPO of this company back in 2002, it is also interesting to see that it has been able to achieve over 11.9% of average return, which is even better than the Canadian index as a whole, as well as the Canadian Real Estate Companies Index. In their latest earnings report, their rental income generated by their multiple properties has also been able to grow by over 5.5% year over year, which has helped them to significantly increase by over 17% their funds from operations. An excellent news for the shareholders of SRU is also the fact that the company is able to distribute over 7% of dividends to their shareholders, which makes it one of the best Canadian REITs on that regard. Nevertheless, with an FFO payout ratio exceeding 83% right now, it is showing that this dividend might not necessarily be sustainable in the long term because they are currently using a lot of their earnings to pay them, and it also also means that they are not necessarily able to have a lot of money left after it to be able to reinvest it to buy new properties. In terms of their net asset value, we can also see that it has been slightly diminishing compared to what it used to be 1 year prior, but with a current price to NAV ratio of 0.73 right now, it is showing that the company at the moment is trading at quite a discount compared to its current net asset value. So there you have it. Those are 3 of the best Canadian REITs that you can buy right now and hold forever if you're looking to earn great passive income. Indeed, REITs have an important rule to distribute at least 90% of their total taxable income to their shareholders in the forms of dividends, and it is why these types of businesses might be pretty interesting for people that are looking for some safe extra income every single month. However, on your side, if you're looking to find other Canadian alternatives to see some great potential growth over the next couple of years, well, check out the video that's gonna be right over here, and I will see you soon. Peace!